Payment platforms Block and PayPal, they are on the move today, but in divergent ways. After PayPal cut its full-year revenue forecast, while Block saw a 51% pop in its Cash App business year over year. BTIG Managing Director Mark Palmer joins us now. Mark, great to get some of your perspective here on these two fintech names. Now, we're seeing the stocks react in very different ways here, but of course, the company is saying something very different about what their forecasts may look like. Perhaps we can start with Block. Key takeaways and what was the catalyst kind of going forward for them that is different from PayPal?
Yes, thanks very much for having me on today. Block is in a very different position than PayPal, simply because through its Cash App, it is offering a bank account substitute to consumers, particularly on the lower end of the income spectrum, who really benefit from those types of services, especially at a time when a lot of banks focusing on their own profitability are throwing up the gates and letting less consumers to start bank accounts within their platforms. So it's got a mission critical functionality, while at the same time, its seller ecosystem, which is basically allowing point of sale payments, has remained robust, which we believe is largely because the company is offering tools to small businesses and medium-sized businesses that enable them to better manage their payment needs.
Mark, it's Julie here. It's good to see you. Talk to me about Cash App versus Venmo, because I sort of think of those in the same bucket, although I know Cash App sort of has broader applications. Is Cash App taking share from Venmo, or is it just expanding the pie entirely and signing up different and new customers?
Yeah, we believe there are very different use cases for Venmo versus Cash App. Venmo, it historically had more of a social element. It has more of a focus on a somewhat higher income demographic than does Cash App. So it doesn't really serve as a bank account substitute the same way that Cash App does. And one of the things that we really saw in the third quarter was Block really leaning into the banking functionality associated with Cash App. And we expect that to continue, making it even more relevant to the lives of the people who are using it.
Mark, the last time I caught up with the PayPal team, they were pitching the story of expense reduction and a pivot in operating margins next year. I mean, do you agree with that? And if so, what does that pivot look like?
Well, we agree that they're pivoting. If you look at PayPal today versus where it had been a couple of years ago, the orientation is just very different. A couple of years ago, the focus was on ubiquity. It was on customer acquisition. It was on the top line growth. And this is how PayPal became a stock that was trading at north of 60 times earnings. Flash forward to today, and we see a stock that's trading at a below market multiple, somewhere around 16 times earnings or a little bit below that. The reality is that PayPal has pivoted toward being what we believe to be more of a mature model, focusing not on customer acquisition, but on increasing penetration of existing customers, cutting costs to drive the bottom line. These things are prudent in an uncertain macroeconomic environment, but they don't represent the characteristics of the growth stock that PayPal had been a couple of years ago.
What kind of growth gets evaporated when you layer in an Apple Pay and any continued furthering of their own fintech ambitions as well?
Yeah, it's interesting because one of the things that PayPal has done historically is rather than try to fight some of the big tech titans who are getting into payments, they've collaborated with them. We saw this with their tie-ups with Visa and MasterCard a few years back. More recently now we're seeing PayPal collaborating with the likes of Amazon and Apple, trying to maintain their relevance. And frankly, we believe that the announcements that the company made with regard to you being able to integrate Apple's tap to pay, things of this nature are making its payment functionality more robust. But when you back up and look at the bigger picture, the question is, how is this company going to be able to sustain growth? They're guiding initially to 15% earnings growth in 2023. But at the same time, they're making a lot of statements about the vulnerability of their end consumer to an uncertain macroeconomic environment, thus putting that 15% growth, in a very risky position right out of the bat.
Mark, you're out here this morning keeping your buy rating on Coinbase after their earnings last night, but taking your price target to $110 from $220. When will this company live up to its promise?
Well, I think that's largely a function of what's going to happen in the end market. Coinbase can and is setting its sails, but it can't control the wind. And the wind in this case is the crypto market, which is very much correlated with risk assets in general. And as the Federal Reserve continues to tighten, the outlook there is very much uncertain. So what are we seeing? We're seeing Coinbase preserve its optionality by focusing on maintaining a large cash balance, building out its institutional prime brokerage platform, and continuing to add new functionality in areas like staking that are relevant to those in the crypto space. So I think what we are seeing now is a lot of building that's going on, not only in Coinbase, but among Web3 platforms in general, in anticipation of getting a bit more of a tailwind so that you can see the full realization of the platform's potential.
BTIG Managing Director Mark Palmer, always good to see you. Have a good weekend.